Thanks so much for tuning in to the Mutual Fund Show. Budget is done and the markets have been wobbly, yes, but I think the whole purpose of this show is to try and tell you what changes have happened in the budget and how can those changes impact your mutual fund investments, current investments, prospective investments. Does any product become better as compared to the other? I know almost everybody now knows about the basic changes that have happened to long-term capital gains tax treatment, and the slew of queries that we've gotten today are with regards to that. So without much ado really, let me get in our experts on board to talk about how are they or what are they seeing this budget having changed in terms of the investments towards mutual funds, and are there some alternate recommendations that they come in as well? Gajendra Kothari of Etica Wealth Management and Roongta, noted investment advisor, both of them joined me on the show. Thank you so much for joining, gentlemen. Now, to your mind, from a mutual fund investor's perspective, does this budget cause some real damage, or this is something that a mutual fund investor and an average mutual fund product can take it in its stride?
So let me put it in two buckets. One is sentimental sentiments, another is facts. Clearly on sentiment, any tax causes a negative perception. So to that much extent, a tax on something that you were supposedly enjoying for free for about 13 years now, it causes a negative perception. Fact. So what is the impact of all this, right? I think for investors, and now we've been doing this for some time, I think investors should be looking at investments not as an end in itself, right? Investments are a means to an end. The end is meeting the goals for which you're making those investments.
True.
Right? Investment is not a sport. You don't have to come first, right? You have to complete the race.
Correct.
Right? I think that is, if you understand that, I think most investors understand that now, beginning to understand.
Yeah.
Let's look at the fact, what is the impact of such an event as a new tax on such investors. Two things can happen. Because of the tax, your return from equity comes down, right? So you might want to evaluate to see whether the investments that you were making to meet your goals, whether they need to be increased now because the assumptions around returns you may reduce versus what they were earlier. When would I do that? Not now. Let the legislation actually get into place. Maybe there might be changes. That's not something I would do right now. Second, which is nothing related directly to the LTCG tax, but to the downtrend in equity. Typically, a big spike, plus or minus, could trigger an asset allocation review. You should anyway review your asset allocation at least once a year. But if there is a big spike up or down, you might want to do a midway review. Right now, I don't think there has been a big spike. 5%, yes, right? But please remember, at least the index levels are still higher than what they were on 1st January.
Sure.
Right? If at all, in your case, because the portfolio or whatever you had planned for yourself, your equity or your debt, if it is still, if it is your equity has fallen because of the fall, maybe there is a case to increase the equity. But I would suspect that in most cases, they have not reviewed it when the equity increased. So they will not really find any need to review the asset allocation unless it's their normal review date.
Okay.
In which case they should do it. In short, I would think that for somebody who's planning for the long haul, this is not really something that should change anything just as of yet. It is something you keep your eye out for. If you're planning for something short term, next 2-3 years, maybe that's something you sit down and review.
And I'm sure there are a lot of queries which have come with regards to that as well. But the reason why I asked this question to both of you, and the reason we are doing this show as well, a simple example. Somebody in my makeup room today said that I want to start an SIP for my bhabhi, but there is a tax. Now should I do it? People are in a manner of speaking, spooked sentimentally by this. To your mind, and if you've received some queries, maybe some of your higher clients will not, but in case you have some small ticket clients who've asked you about what this means, what have you told them?
No, very true. Of course, any investors now, whom we meet, they are aware about this,
Yes.
So this time budget, everybody has taken note of it actually. But, all we have to, as Harsh mentioned, something which we have been comfortably, taken for granted 13 years, no tax regime. Now, if suddenly it comes back to us, will be uncomfortable. Any change for that matter will be uncomfortable, right? Having said that, what is the impact? It's 10% long-term capital gains tax at the time of withdrawal. See, one should appreciate that this is a tax which is a deferred tax. Unless you're going to withdraw, you don't have to pay tax. I'll give you my own example. For the last 13 years, I've been an SIP investor. I've only put in money into the markets. I've never withdrawn it. So for me, whether there was a tax or no tax, it didn't matter at all in the first place, right? One should understand the power of deferment. It's a compounding in itself.
Sure.
In fixed deposits, if you're a 30% tax bracket and you have gone for a deposit which will mature at after 5 years and you'll get all the cumulative amount of after 5 years, tax you have to pay every year. You can't pay tax at the end of 5 years. There's no deferment. So this in itself is a great thing. So I don't think, as Harsh mentioned, this is not a material impact. It will, of course, have some impact, but the kind of returns you get in equity over a longer term in itself is far above than any other options you can consider.
Okay, now, I'll also, of course, get in viewer queries to really show you by use of charts and graphs as to why this may not really make too much of a difference. I just want to lay out the scenarios, and please correct me, gentlemen, if I go wrong in any of these. But remember, there are 5 things, right? As in stocks, so also in mutual funds, probably, that if you have an existing investment, and I would believe the grandfathering applies to the NAVs of mutual funds as well. So the price, the NAV as of 31st Jan now becomes your base price. And whenever you sell, whether you sell it if you sell it henceforth post April 1st, the NAV of Jan 31st would be the base price, and your gains are calculated on that front, right? Am I right on this front?
Broadly, yes.
Broadly, yes. Why not completely,
yes? Nothing in tax is complete. There would be so many exceptions to what you said. First of all, that would be the base provided it is higher than your cost. Otherwise, your cost remains the base.
Correct.
Right? It would be the base provided you have completed 1 year.
1 year.
So, there are many such exceptions. And which is why, the idea is that people talk about tax harvesting, that, you should sell a bit every year and take advantage of the 1 lakh. I want to make it clear to viewers here, don't try this at home.
True.
Tax harvesting is for the rich folk. And the reason it is for the rich folk is because it requires expertise, right? Expertise costs money. So tax harvesting makes sense, but the amount of investment you need to bear the cost of tax harvesting, which is the expertise, is large. Don't try it at home with small investments.
Okay, I think it's a pertinent point. Key, the other one thing that somehow I've learned by all my conversations is that if you get out of a stock or get out of a mutual fund, it's very difficult to get back in, even if you've done it from a tax purpose. And I think Pranav Sehta from ENY brought out a very important point as well, that while general anti-avoidance rules or GAR is used perceptibly for large investors, but if you exercise some buy and sell in order to avoid tax predominantly, there is no saying that this will not be applicable to you as well. So just keep that at the back of your mind. Let me start taking some queries, and viewers, remember, feel free to write in your queries. You can post in your queries on our Facebook page, on our Twitter page as well, and I'll take some of those queries live too. We already have a bunch of queries, so I'll try and take as many as I can, and we'll also do a small discussion with both our guests on ULIPs and whether ULIPs, which are not subject to LTCG because of section 1010D, if I'm not wrong, do they become an attractive investment proposition compared to mutual funds? If you are debating whether you need to put money into ULIPs vis-a-vis mutual funds, we'll get those queries answered as well. But let's start off with some of the queries that have come in, gentlemen. Ronit Sharma writes to us on Twitter. He said that he's okay, this is a stock question. I don't know. Do you guys want to take a stock question as well? It's regarding the tax treatment, really. No. But he's asking about...
I can take a tax question.
Yeah. So it's a tax question. He's saying that he's invested in IndusInd Bank since its IPO, what would be the impact if he sells before March 31st or after? Any thoughts here?
Before March 31st, the tax impact is the same. There is no difference. In the end, of course, IPO had happened some time ago. And post 1st April, if he sells, the cost that he had paid at the IPO or the highest price as on 31st January,
which would be highest price on 31st.
That would be higher than his IPO cost. That would be treated as his cost. And since it's going to be long term, since he has held it since the IPO days, only if the price is higher than the 31st January price, would there be any LTCG tax?
The fact that investing in an IPO did not attract STT and grandfathering would be applicable
that
to
is, so there is a provision for a notification in the 1030, okay, sorry to use jargon, in the existing exemption which was existing, also this provision was put in and notifications have been issued. An IPO would be covered even though STT was not paid. In the FAQs that CBDT has come out 2-3 days ago, they have mentioned that they are going to repeat the same notification for the new section, proposed section as well. So the IPO is going to be covered.
Okay, fair call. Nitin Soni, I think it's a generic question, wants to know the impact of LTCG on his future portfolio and whether anybody who's got a long-term portfolio, Gajendra, should he book profits? I think Harsh in part answered that, but let me add, because Nitin would want to know the answer to his question. Should he book some profits right now, part profits, full profits, and reinvest the money later on?
No, it doesn't matter, Niraj, because, anyway, 31st January is the cutoff date, and at least now the price is lesser than what was on January 31st. So maybe if at all he's concerned and wants to, before just March 31st, he should have a look at it to square off the positions or, in mutual funds. I don't think there'll be a substantial gain anyways, actually. So if at all he wants to do, he should do before 31st March. But otherwise, even if he ignores, and as you said, he's a long-term investor, this doesn't really matter at all in the longer span of investments.
Okay.
So it's not worth the exercise.
Not worth the exercise. Okay. Now, a slew of queries that we've also received is, and the surprising thing is I saw headlines which spoke about how money would now flow back to ULIPs because ULIPs have that tax advantage over mutual funds. Now, what are your thoughts here, gentlemen? Harsh, let me start off with you.
So I think let me reverse what I said in answer to the first question. What does the tax do? It reduces your return. Therefore, what does a tax exemption do for ULIPs? It does not reduce the return.
Sure.
Right?
Or gives them a 10% extra return over.
It does not reduce the return.
Okay.
Whereas, so what is a ULIP? ULIP is a mixture of a insurance policy with a mutual fund, right? The mutual fund portion would now not have its returns reduced, whereas the mutual fund portion, if I were to invest in an equivalent mutual fund, and I'm presuming we are talking equity,
yes.
in an equivalent equity fund, if I was to invest, then my return would be reduced by a certain percentage. Now, that is the advantage that supposedly ULIP enjoys. What are the disadvantages? First, unlike a mutual fund, I'm stuck with the mutual fund house, with the insurance company. I can shift funds within the insurance company, but I cannot shift out.
For a period of 5 years.
5 years.
Even later, if I shift out, you see the whole principle of ULIP works on the fact that the expenses are upfronted. Some amount of expenses are upfronted, which you would get benefit in later years. Overall, the expense ratio they would claim is less than mutual funds or equivalent to, let's say, direct funds. Now, if you get out after 5 years, sure, you can get out, okay, but you would be losing a lot. Bigger thing, do you need the insurance? You're going to pay cost for the insurance. Please remember, it is exempt only if the insurance is 10 times your premium. So it's not a insubstantial amount of insurance.
No, sorry, can you run that through me again?
So if I'm, for example, investing 50,000 rupees or per month, that's 6 lakhs a year in an equity mutual fund. If I was to do that in a ULIP,
yes,
my insurance sum assured needs to be 60 lakhs for the section 1010D to apply.
Okay.
For 60 lakhs, the premium, depending on my age, and as I age, the premium will increase dramatically, that will be a cost. Now, do I need the insurance? Not everybody needs the insurance.
Sure, okay.
Insurance is a cost, right? So that I mean, that's a cost. If you need the insurance, then it's not really a cost because you would have taken it anyways. Okay, but if you don't need the insurance, then that's an unnecessary cost.
Okay.
Right? So I think this combination of an unnecessary cost, if at all it is unnecessary, and the fact that you're stuck to an insurance company, plus you make a commitment for 5 years. Remember, in an insurance ULIP policy, after 1 year, if I discontinue, the value will move into a debt fund automatically, a discontinued fund, which is essentially a liquid fund, right? So all the benefits of equity will go away. So I'm committing not just to the first year's premium, I'm committing to next 4 years premium. I think there are several disadvantages to a ULIP, which I think makes it unattractive. I think a lot of investors have realized that mixing insurance and investment is a terrible cocktail.
Okay.
Right? So I don't think you will be able to get those people to drink that cocktail again. I think, as Gajendra was saying, there are going to be distributors, primarily the banks, okay, who would find it more profitable to push ULIPs.
So should investors avoid or refrain from taking that advice from a bank to go for a ULIP? That would be the question, right? That's why we are doing this show.
Obviously,
to tell people what they should be doing.
Obviously, because Niraj, what happens in a bank, normally the way we have seen is most relationship managers try to push your product.
Yes.
Because they would have targets given by their seniors and they have to sell the particular thing, whether it makes sense to you or not as an investor. But if you go to an advisor, he will see your risk assessment, your time horizon, your capacity and everything, and then he'll advise you the right course of product. Just because the tax is not there right now, and always remember, we don't know what is going to anyway happen after 5 years.
Sure.
In the 5th year, when your chicken comes to home for roosting, what happens we don't know. So, and you as Harsh mentioned, you are committed for 5 years. You have to pay premium for 5 years. And in ULIPs, typically what happens, the charges are upfront. So again, you are not starting with 100, you're starting with 95 or 90 rupees. So to come back to 100, it will take at least 5 years. One more important thing which many people don't consider is the performance itself.
I was actually going to come to that. I have a question, Gajendra, and please bear with me. It's a very simple question, but it's something that I would want to know myself. Let's say I'm taking a numerical example. Let's say I have 1 lakh rupees which I want to invest between a mutual fund and a term insurance plan, which almost everybody says if you want to go out for insurance, take a term insurance plan. So now my question to you is, an average mutual fund, I don't have the expertise to really choose a great mutual fund. I'll just choose an average mutual fund, let's say, and I'll put in some money in a term insurance plan versus for a specific amount that I want insurance for, versus I put that 1 lakh rupees lump sum in a ULIP plan. And let's say my period or my horizon is 5 years at least. Would I earn better returns in a term insurance plan wherein some of the money will go away and not come back to me, assuming that I live 5 years, and the part of the money will be in a mutual fund versus that entire money being in a ULIP plan?
So if you take data with historic, from last 5 years point of view, the existing data, I'm sure 95% of the cases, mutual funds would beat ULIP products. Even after accounting for charges for term insurance and everything, hands down. In fact, we did this exercise yesterday for an investor who has invested for 11 years 1 lakh rupees premium into a particular mutual fund, into an insurance company of a large conglomerate, and we took the same mutual fund from that same house.
Okay.
Just to show the investor like-to-like comparison. In one case, that 11 lakh in insurance has become 24 lakh today. In mutual funds, it would have become 43 lakh rupees today in the same manner.
So he could have invested slightly less, still earn more, and put the money in a term insurance plan
of the
if he
same
wanted
company,
insurance.
Of the same company,
okay,
and would have been far better off.
Okay, so both of you kind of come to. I have a lot of questions, which is why. But yeah.
So quick disclosure. I mean, both of us are more interested in mutual funds. I don't think either of us distribute insurance policies, so that is a disclosure to whatever that we are making.
Agreed.
But it makes sense. I agree with Gajendra.
I wouldn't put my money, more than anything
I think
else.
that's a much better way to answer, right?
Sure. Okay.
Where would I put my money?
Even
to
after this tax arbitrage, you will not.
I don't think it makes any difference.
So I think that's a clear answer. And please remember, when your relationship manager, if you have one, comes and sells a ULIP plan, please come back and watch this show. You will get confidence not to do that. Maybe.
I mean, I would go so far as to to say, stay away from your bank branch.
Okay. Now I have a few questions. There is Archit Srivastava who wrote to us. He's a large investor. He's saying, I have 50 lakh rupees invested in HDFC Prudence Fund with monthly dividend option since the last 9 months. What should I do with 50 lakhs now after LTCG comes in? I need some income regularly to support the family monthly expenses.
Yes. Okay. So, Archit, I think the clear answer is in first case when you're doing the monthly payout, first of all, you should know that monthly payout is not guaranteed. Okay, mutual funds can't guarantee you monthly payout. So if you're solely dependent on this income, this may not be a good idea in the longer term. The way markets are sliding, if it continues to slide for another 6 months or 1 year, there may be challenges. If you want a monthly payout, I think the best option is to go for systematic withdrawal plan. In the same fund, you can go for systematic withdrawal plan. So if you have nested 50 lakhs in a prudence fund, depending upon your requirement, you can go for an 8% withdrawal per annum or maybe a 10%. Okay, then then things are in your control. You can change the amount whenever you want. You can choose the dates, and it will be certain whether markets are up or down. Okay, and after 1 year, the tax will be 10%. In the first year, from now on, it will be 15% at least for the first year. But after 1 year, it will be 10%. So the tax treatment is also similar if you compare the dividend option of the mutual fund or the long-term option. So that should not really help you decide, but SWP anyway is a superior strategy than a dividend payout if you are solely dependent on the monthly payout of the fund.
Okay,
and you should do that whether or not the LTCG tax is withdrawn.
Okay.
Yes.
I think you have been missold a product.
Yeah.
Get out of
it.
Okay, so irrespective of the tax, I think both our experts have given you your answer. Archit, I hope you benefited from that. There is just one question that has come in. I'll just take it, probably can give an answer. Mayank Afle is saying, hello sir, can we assume that LTCG tax will be increasing every financial year? Mayank, I don't think anybody can give a reply to that, but for the finance minister, okay, you want to?
So, look at the history of the dividend distribution tax. If you remember 97 dream budget, right? Chidambaram's dream budget, he said dividend will be exempt, and in lieu of that, I propose a nominal 10% DDT, dividend distribution tax. That 10 increased to 12.5, that increased to 15. Then they said grossing up, so it became 17.5. Then they said a 12% surcharge. Then they said a 4% 3 or 4% now cess. Today it is 20.55 plus if the dividend is more than 10 lakhs, you pay a 10% tax plus a surcharge plus an education cess. My point is, today, if the exemption, so-called exemption of dividend is removed, the government will make less money from taxing dividends than it makes from supposedly exempting dividends. So if you take that as a history, okay, I would completely agree with the apprehensions, and that is really the apprehension. This tax does not change too much, but this creeping increase that invariably we will be subject to is what I think.
And once governments impose taxes, I think it's very difficult to go back. This year people were expecting LTCG may come, but STT will go away.
Sure.
And now you're both.
Yeah, but I'm just saying, I think it's difficult to preempt what the extent of increases could be in a tax structure like
Absolutely.
this. That's my limited point, really.
Taxes should never be the focal point when you decide on the entire financial
Okay, I think that's sound advice as well. So, okay, great. Thanks for that. We also have a phoner query, but just before that, I just want to take in a query from Rashmi Rajdan, and she wants to know if she has LTCG on her equity portfolio, and if she books profits before March 31st, will it be subject to LTCG tax?
No. As Harsh earlier mentioned, anything before 31st March is normal course of action. Anything after 31st March, then January 31st date kicks in and you'll have to calculate record.
But this would also be if she's bought in more than a year earlier. If she's bought it in the second half of 2017, then she'll be subject to some taxation, right?
Then it is a short-term
capital gains tax.
Anyways,
so
yes.
Rashmi, it depends on, I think, the purchase date that you've had.
Precisely.
But it will be subject to this change in regime only, I think, post March 31st.
Yes.
Okay. Anything else that has come in, and before we get the next query, anything else, gentlemen, that has come in terms of an interesting query to you from the slew of people that you would have spoken in the last 4 or 5 days that you want to bring out? Some misconception or something that should be cleared via this show?
No, so I think fortunately, because of the kind of education to investors that has happened, courtesy of these kind of
platforms,
shows.
yes.
Budget front, which I want to clarify, this dividend distribution tax or the imposition of LTCG, there was a product called equity savings fund, which was getting into huge flavor in the last 1 year or so because FD rates were coming down. So this was a FD plus product, pitch into the investors with 25-30% equity exposure. With this tax coming in, the differential is not huge because anyway you have to pay 10% tax on the return. And suppose, let's say the returns from this kind of product was 8 to 10%. Now you have to pay 10% tax. Earlier it was tax-free. One way to look at is what is the alternative now? So many experts are now saying, could MIP come back as an alternative? Because MIP is also a similar product with 70% debt and 30% equity. Of course, it has a 3-year taxation. But after 3 years, you enjoy a 20% tax with indexation benefit. Okay, that may perhaps lower the tax impact compared to a pure 10% long-term capital gains tax. Okay, and equity savings fund being 25-30% goes into arbitrage. A debt is a much better option. A 70% debt is a much better option compared to here 40 debt and 30 arbitrage. From returns perspective. So this, I think MIP could come back strongly as a category, compared to equity savings fund, purely from tax and returns point of view for a conservative investors.
But a sincere request to every conservative investor as well. If you are thinking of doing this based on Gajendra's thoughts, please consult your financial advisor before you go ahead, looking at your goals and your portfolios as well. We have to wrap up this show, but I know I've not been able to take some of the questions. What we'll try and do is request our guests that if they do have time over the course of the next 4 or 5 days to try and respond to some of the queries that have come in via this show and not otherwise really. But until now, the queries that have come in, if they can reply to some of the queries, we'll request them and do so. Gentlemen, thanks for being a part of this show today and coming into the studios as well. And viewers, thanks for tuning in to the Mutual Fund Show.